Hello and welcome to this week's financial market review. We expected a lot from Lagarde's speech, but nothing really came out from it. She maintained a December stance, indicating that the Eurozone economy should rebound by 3.9% in 2021 after a 8% contraction in 2020. Maybe it's a bit ambitious when looking at the January preliminary economic activity of the region that came short of expectations, suggesting another month of contraction. That's pretty much disappointing, given that we know that it will take several months for the Eurogroup to disburse the €750 billion package voted in June last year. Keeping in mind the pace of ongoing vaccination, will the second quarter rebound really happen if no further monetary stimulus is provided? Such a hawkish stance keeps the euro artificially strong and European peripheral yields higher. Conversely, and quite unexpectedly, the US economy has upheld its recovery path in January at an even faster pace than that of December's. This will facilitate Powell's job this week during his monetary policy speech. Nothing much is expected, as the ball is in the Senate's court to approve Biden's package. Powell will likely raise concerns about the recent new jobless claims, further pressurizing the Congress to pass the bill. But he is not in a hurry to further support the economy at this stage. This week, earnings releases will provide an in-depth understanding of the current American economy. Amongst others, Tesla, Apple, Microsoft, Facebook, and Chevron will release and will feed or overturn the current pullback sentiment that US equity markets are expected to decline by about 5 to 10%. The consensus is expecting a drop in last quarter's results of about 10%, but so far, most US companies that have disclosed their earnings have beaten the consensus. Nevertheless, a mere correction will give the market some rest and will avoid an increasing likelihood of a bubble burst. For the time being, we see investors rushing into any type of assets. Even the 50 years French bond issue was 10 times oversubscribed for a low yield of 0.5% per year. Stay tuned for our next roundup, and until then, have a nice week ahead.